So none of that product came out yet, and no Rob Chrisman rookie card yet, Mike. But I did find out from Robbie that the Nolan Ryan rookie cards are coming to me in your will. Robbie was telling me. Rob,
Did he now? Did he say that now?
yeah, he's trying to negotiate them back. We're working on a deal, but was pleased to hear that, and that would have been a nice surprise. So, those that don't know, on Rob and I's former show, he just casually pulled out like 8 Nolan Ryan rookie cards on one of the shows. Highly valuable. I was like shaking when I saw them.
So that actually leads into the mortgage banking discussion, Rich, because what they're worth to me is what I paid for them, 50 or 60 years ago or whenever that was, which is, a nickel or a dime for the pack, and you were in it for the gum.
That's right.
So would you, like, a quick aside before we get into mortgage banking, I know everyone's waiting to talk about mortgages. Would you, Rich, recommend, like Tops? I can go to the store or I can go somewhere and get a box of this year's cards. I can go. So do you recommend buying that box of basketball, football, and baseball cards every year?
It's all about the rookies. I'll say for baseball, the 24 rookie class is looking good, but the 2023 rookie class for baseball is like legendary. Corbin Carroll, Adley Rutschman, Gunnar Henderson, Anthony Volpe. I mean, Chris Morel and the Cubs. I mean, you can just go on and on and on. There's like 20 rookies that had incredible years last year. So, you look back at 2020 football, Tua, Hurts, Burrow, Justin Herbert, Jordan Love, Justin Jefferson, like an iconic rookie class of skill position guys. 2023 baseball, with not enough time in the rear view yet, it's being viewed kind of through that same lens. So
let me rephrase the question, Rich. And Bill, sorry.
No.
When I can go buy a Tops 2024, 2025 football season box of football cards, do you recommend doing that every year? So over time, you're ahead.
Oh yeah. I mean, if you're able to buy product and keep it sealed, that is always a smart strategy. I don't have the willpower to do that, but maybe one day as I mature. So
right. Okay. That answers my question. Thank you. Good morning, Bill, or good afternoon at this point, Bill.
Hey, we just transitioned.
All right, let's go ahead and get into it. This is The Big Picture. I'm Rich Swerbinsky with Onward and Upward Consulting, and joined, as always, my esteemed colleague and co-host, Rob Chrisman. Rob, good to see you. Welcome.
Thank you.
And this week,
I have to sneeze. Ever get your nose kind of tickles ahead of a sneeze? Anyway, go ahead.
This week, really pleased to have a special guest, guy, really illustrious career in our industry. Looking very forward to the conversation. A lot of cool things he's done in his career as kind of a change agent for the mortgage industry. Started First Franklin Mortgage in the early 80s, took that public, started Cloud Verga, sold that. Most recently did a stint at Finance in America, now advising clients for his company, Dallas Capital. Welcome to The Big Picture, Bill Dallas. Bill, good to see you.
Pleasure, boys. It's going to be fun.
This will be fun.
Looking forward to it.
Let's get into it. So, the chat, as always, is open. And my boy, Bernard from iEmergent, a.k.a. Boston B in the cardboard jungle world. Boston B promoting the cardboard jungle. Thank you there, Boston B, jungle regular. But Rob, MBA Secondary, so much going on right now in the industry. Rohit Chopra, some very pointed words for the credit reporting agencies just a few weeks after, reducing credit card late fees nationally with the stroke of a pen. Some pointed words for the credit reporting agencies. A lot of talks about HELOCs and second mortgages with all the equity. Freddie Mac proposal to get into that game. Your takeaways from MBA Secondary earlier this week?
I'd say the mood was cautiously optimistic, for lack of a better term. And I think I was using that some last year as well. But the attendance was down. I think there were about 1,000 registered. And I think at the heyday, there were probably 4,000 or 5,000 registered.
Mhm.
So definitely companies have cut back, and the number of companies has been reduced. But the folks who were there, I think, were enthusiastic and in a good mood. I mentioned it in my opening paragraph today that we can expect to see continued rollout of seconds and HELOCs given all the equity that's out there. So a lot of folks, I was sitting with somebody who will remain unnamed from Chase the other day at lunch.
Jamie Dimon.
Person will remain unnamed.
But maybe Chrisman LLC was in talks to acquire Chase.
Well, I don't know I don't know if Jamie would show his face around there much, because I think every economic prediction he makes has been wrong for the last several years. But that's a
Mhm.
topic for a different time. The recession, we have the recession that never showed up. But like I said, the a lot of seconds HELOC talk. But aside from that, yeah, you're right. People aren't happy with the credit costs, the cost of credit, a lot of finger pointing, whether it's FICO or the three bureaus or the credit reporting agencies, and how to combat that, whether you charge the borrower up front, and then everybody says their loan officers won't stand for charging borrowers before they fund the loan, or when they take the lock, charging them for credit. So you have that pushback. But I'd say a lot of the folks there are just kind of doing their thing and trying to, from a capital markets perspective, eke out a few basis points here and there, and try to get some CRA credits along the way, and try to give their production staff the necessary products that they need in order to keep borrowers, rather than send them up the street to a credit union or a bank.
Mhm.
But really, nothing earth shattering.
Mhm.
Bill, I know
Were you
you're
there?
advising a lot of companies in the space right now. It's certainly, tenuous times. We're about 2.5 years into a bear market. You made what I thought was a really good LinkedIn post a few days ago,
Thank you.
along the lines of kind of like the 5-card poker hand of success
Mhm.
as an originator in this space right now. And a lot of stuff in there we want to get into, but just kind of broad brush right now. Your just assessment of where we sit right now as an industry, 2.5 years into a bear market, election coming up, and just a lot of changes, the NAR stuff, and
Mhm.
potential government intervention and back and mortgage. Your thoughts on where we're at right now?
Yeah, I mean, you tee it up well, right? You would think that mortgage bankers who've been through changes like 94, 99, 2001, we've hit. I mean, I've been doing it since 80. So I've seen it all. I told Casey Crawford, I had to amend that. I thought I'd seen it all until the pandemic. And then I saw something else. We predicted something would happen, but I would never have guessed the government support, the intervention, the disruption in mortgage, and all of that. That being said, in 18 and 19, and all through that from 15 on, mortgage bankers were struggling. I mean, some were winning, some weren't, but rates were reasonably low, and yet we weren't making money. So I think there's something systemically, my call out would be there's something systemically wrong that you're doing. And you've got to solve it. The first thing is don't lose money. And people can't seem to figure that out. And you can't figure it out when your bloated cost structure is $13,000 to $15,000 a loan. And if Rob's right and everybody runs to a small HELOC, we're going to lose more money because those are worth less and smaller loan balances and generally run by banks. And now you're going to have other people moving into it. So you've got to be extraordinarily careful. I think all my clients have a productivity problem, right? People I was looking at a big public company and the number of LOs remain nameless, 0.7 loans per LO. And they're the leader, right? And so I think and the number of loans per employees, I've companies that I first see, you've got 400 people doing 400 loans. They're building a tomb to entomb themselves.
Mm-hmm.
They'll never. So since Dodd-Frank and since coming out of the Great Recession, what I've seen really is the cost to produce go wacky. We can blame it on whatever we want, right? Compliance, new laws, new rules, LO comp. I don't care. It doesn't really matter. But the way we're orchestrating this and the way we keep doing it, it is the definition of insanity. So what I try to do is say, how are you going to build value for your business, stop the burn, right? And then strategically coming out the other side, if there is one, right? How do you position your company to really be successful and a winner? And it's a conversation, man, because everybody's sort of got, the agency players, all agency, and the non-agency players, all non-agency. And then you've got people that are retail, wholesale, everybody tries something different. And so I think you have to really focus on what you're passionate about, what you're good at, what builds your business model, and you got to conserve cash. And the challenge I see is capital is flowing away from what I would say would be mortgage bankers. Everybody loves single family loans. The single family rental business is doing well. You've got DSCR everywhere, people trying to do all these different things. So capital's flown into HEI, capital's flying into some of the other, what I'm going to call non-government lending things. But in this space, what you seem to have are leases, liabilities, and loan officers, and nobody building value.
Well said.
I have a question, Bill. So I see a fair number of companies that are, maybe they're making a little, maybe they're breaking even, maybe they're losing a little bit, but they're saying, all right, we're getting into we're in the spring, summer season when things pick up traditionally. And at some point later this year, rates are expected to come down somewhat.
Yeah.
Maybe we get into a yield curve steepening environment, but nonetheless, and I'm okay as an owner. I'm okay breaking even until things pick up. So I've cut my way to the bone. I've cut my way to break even, and I'm just going to tread water here for the remainder of the year and hope things pick up. Is that a lot of the attitude that you're seeing out there?
Yeah, trying to get to not burning cash, right? And I think in that case, the thing I see most probably is because of our bloated cost structure, people in the Midwest are going to FHA, DPA, like you were saying. So if your cost to produce is 105, then you got to find a margin in a loan at 105. And trying to find buyers is like trying to find a needle in a haystack. I guess we got plenty of buyers. Trying to find buyers who actually can get a contract on a house is the needle in the haystack. But I think what I tell those people is that could be I don't call the innings in the game. You don't know if it's the seventh inning or the third. And I think it could go on further. Obviously, you saw real estate numbers today on sales down again. So I think treading water is okay if you have a strategy to come out the other side and you don't burn cash. But what people are doing is a lot of my clients, I would say, are trying to go to very valuable FHA products with high gain on sale and with lower credit quality in order to generate enough coupon and sale in order to balance the budget. So we're taking a little bit of credit risk, a little bit more than I would like, in order to tread water. And then if you try to book the servicing first, right? And then so you can pick up the extra 50 basis points that you do by not selling co-issue to one of your competitors or something like that, then you really have a problem because now you're going to have to finance. Now you're not getting the cash, and you're going to have to get an MSR facility, and that's going to cost you 8 or 9, be a mismatch. And I see that as well. So people have desperate strategies, not disparate, desperate. And then I think you see others that are making a little bit of money and beginning to see a light at the end of the tunnel and beginning to talk about things that they could do better, what they're trying to do. And the wisdom is probably to know the difference, because the ones that keep telling me, okay, we're losing money, we're almost there, we're going to get there, going to do it, they just keep losing money because next month is worse, or locks fall out, or they have a secondary catastrophe, or they get a repurchase request. Your maintaining cash is the hardest thing in mortgage banking. And as you're growing, it's hard. And when you're shrinking and losing, it's hard. So we're very rarely in that EKG that's like consistent. I've always tried to manage mine so that our highs and lows aren't massive, but it's a different kettle of fish right now because of the lack of inventory, the NAR settlement, what's happening on the buy side, what's happening in mortgage in general, right, in terms of products. So and because we've got so much equity, why aren't people taking it out? Well, nobody wants a 12% second. Nobody. I mean, if you take it, and who wants the payment? So, and if I don't know where I'm going, then I can't refinance my house. And so you're seeing people this slow sort of move up, move down, get out, fix my stuff, do whatever I'm going to do, versus, the way it normally would work, because we've got a bunch of different impediments, from the first time home buyer to the move up buyer. And then the boomers are just sitting around with a lot of cash in their house, trying to figure out what they want to do. They want to move to, like we said, right? We have granddaughters now. We have other things that we're thinking about, and I've got 5 kids who are all millennials. So it's like getting them into houses was the number one priority as early as we possibly could. And then teaching them about real estate and what to do.
On the second mortgage front, Rob, I know we talked about this a couple of weeks ago. You thought pretty firmly that the Freddie Mac equity loan orgy would go through. Any words, at secondary, the cocktail party circuit, one way or the other, which way FHFA may go with that?
Not that anybody said anything. I didn't hear anything concrete. It's just a lot of, what do you think about that? And it's kind of like, I don't know. What do you think about that? I don't know. Kind of thing. There are other programs similar to this Freddie Mac proposal that people or companies could avail themselves to. Bill brought up the loan amount. The question is, what's an interest rate? What's the interest rate going to look like? Mm-hmm. So there's a lot of things out there that people are kind of like,
if they want people to take equity, Rob, they should just lower the rate, or let us do a buy down, or the thing that's missing to mortgage is the adjustable rate mortgage and a yield curve. And so since we always fix these things in years before by shifting our mix from fixed to ARM, you don't have it. And if you have to qualify at the fully indexed rate of a bullet, then what good is it? So I don't get it. And then if you want to fix it, why does Freddie Mac have to do a second? Just do a new first. Well, you know why? Because they got all these investors. They don't want prepay speeds to jump up. So if I put a second behind it, I bury the first. I solve the prepay speed, but I can't envision them trying to figure out, okay, if I'm going to run an AUS, how am I going to do that? If I have to go through a full process to do this, there's absolutely no way we can make money. None. So you ought to, if they want to send me a note and say the Dallas loan is good to go for $50K, and all I have to do is draw the docs, right? Or do whatever, that works. but they don't do that, right? They just won't. So my concern is we have Figure, we have, Spring EQ, we have Symmetry, we have some companies that have jumped out into the space, and then you see some companies in non-QM doing closed-in seconds. I still think those products are not the solution. I'll give you a product that I think is the solution that no mortgage banker does, that exists, and that would be an equity share. I mean, I have one client in this mess, or in this new product queue, HEI, they call it, home equity instruments or home equity contracts. And I like reverse, obviously coming from Finance of America, we like reverse, don't like forward that much, but we like reverse. And so why is reverse successful? No payment for over 62. So wouldn't it make sense to offer people? I do think we have two types of borrowers. I think we have what I'm going to call income statement borrowers and balance sheet borrowers, to stick with the financial statements. I got people with assets. I call them A's. I got MNAs, mass non-affluent, affluent. That's the only two clients that we have. And you have to have two different structures for an affluent client than you do for a non. And if you have income, you can go down the path of qualifying them and go through all of that. If you don't, and you have the asset, then it's probably better to give them an equity share, a partner, give them the cash, have no payment, and move on. But that's not mortgage, right? It's hard. We're used to loans. We have to disclose things. We're used to fees and all this stuff. That industry, the HEI industry, it's not a loan, right? It's a partner. So title's different. All these things are different. So what I've learned is this would be a great product for us, for all customers. And I think the way to do it is, I call it the matchmaker loan. We're doing it with Equify, but it's basically a deferred payment second, right? I have a coupon. You're going to make a payment at 4, and then you're going to share equity for the balance. People will take that because the payment's low.
What happened to what was the name of that company? Rex? Was Rex?
Yeah.
That was something they were doing, wasn't it?
Yeah, nobody has really cracked the code to move. All this is being done by fintech companies, Unison, HomeTap, Point, Domochi, those companies. And then there's a few like Chiave or what were they before? I forget the fix and flip people. They're sort of nosing around in it. But investors are beginning to cluster to it, because in hedge funds, the insurance side of, let's just take Blackstone or Apollo Athene, the bigger ones, the insurance side and the real estate side are beginning to converge. And this is an asset. I mean, all of our jumbo reverse loans that weren't HECMs were securitized. And we securitize those with 100+ investors at Finance of America. And those loans go to generally insurance company types that fit into these big hedge funds. So that product is new, different, makes some sense, won't fit for everyone, but actually does fit for some. And I've already seen, I mean, these companies are doing record volumes. There's just no investor for it, or limited investors for it.
Last week, we had Bob Brokesmith on. He's now calling for a housing policy czar nationally.
I love that.
So formally, yes. I
idea.
wanted to Bill, your thoughts, Rob, your thoughts. I mean, it's astonishing to me, given what a large component of the overall economy, housing and housing finance is, how little they know about
It's
our
always been a
industry.
mess like that.
I mean,
I think if we have a czar, what I don't want is the czar and the posse to show up. You can have a czar, but you can't have a czar and then 5,000 people like they do with the CFPB, or you create a new institution and suddenly you've got a bunch of bureaucratic people who come to work for it. If we have a czar who could help us tie together all the things that Bob's talking about, then I think yes, because we have so many contradictory rules and laws. It's almost unbearable to run a mortgage company.
Rob,
Yeah, I don't know how
housing czar.
multi-state organizations do it, frankly. When you're dealing with FHA and VA and Fannie and Freddie and non-QM and HFA and reverse and so forth and so on. Yeah, if you were to land on an island, the odds of you recreating our exact system because it works so well are minuscule. You know, you wouldn't.
Well,
you
what's
wouldn't
interesting,
you wouldn't want to
I
do
think
that.
the one that I puke on is just state licensing for every MLO. Okay, if I'm a bank, I don't have to do that. I mean, so what? So our people have to get licensed, have to maintain licenses, can't refer loans back and forth, very difficult, have to be licensed in multiple states if you want to try to do that. You spend most of your time trying to actually get licensed, maintain your license. If you're inside the organization, you got to have all the SAR training, all the other things that you got to provide. And it's a nightmare to try to do it. Every loan officer hates it, everyone. And if they move from bank to mortgage bank, they almost can't do it, right? It takes too long and they can't pass the test. So I think the state licensing component has to go. It won't, but it should. And they should bridge those so that there's no unfair advantage to banks or credit unions or somebody else. I mean, that doesn't make any sense. We're doing 70% of the volume. Suddenly we've inherited the earth because all the banks went out because Basel III. A bank, your warehouse bank, your jumbo buyers, the people that buy our MSRs are leaving the industry in droves. They're scared shitless of Basel III. So you can't, if you own an MSR asset, it's like risk weighted at 250%, right? If you're going to be, that's why the warehouse banks are leaving.
While the federal government laments the risk of non-bank servicers.
That's my best line, right? I'm from the government and I'm here to help you. Well, that's bullshit. I mean, it just doesn't make any sense, and it makes our business so much harder. So yeah, we need a czar. We need somebody to say, stop that, do this. These aren't symmetrical. You can't do this and this. Let's just talk about our core business, affordable housing, helping the underserved, going to higher LTV, all those things. You go to the other side of the business. I mean, there's so many laws and so many rules and so many things that keep us from doing that. It's like I've always said, we talk out of both sides of our mouth, and somebody has to, in the MBA, God bless them, they have grown immensely into our industry. I mean, I was telling somebody, even in my article, I went, what was the volume when I started in 1980? 100 billion. That's not a good month at Rocket, right? So 100 billion for the industry. We're now doing 2 trillion and we're complaining and we can't make money, right? So, okay, something's wrong. And my point is, and that's what I'm going to harp on, is you need the ace in the hole. You need 5-card stud. You need to actually change, because you are going to get crushed even if you survive, if you don't change, in my view. And if you're a mortgage company and you are not building assets, and the only 2 assets you have, 3, make money in your platform. 1, most aren't and never do, make a little, right? 2, I think own the servicing asset. Most don't, some try, but many don't. And the 3rd is the data that you have in your consumer, and you sell that servicing release. And then you sign an MLPA or some agreement that says, if you touch that borrower, I'm going to slap your hand. And you can't, and if it early pays off, you have to pay it all back. And they just keep going, right? And you repurchase it if it doesn't perform, and you find this. So I'm telling you, guys, this is a tough business at a tough time and you need to rethink it, you need to retain the asset. You need to not sell loans to people that are your competitors who preclude you. You need to retain the customer for life, and you need to build an asset in the organization, right? You need to create valuable franchises because nobody wants, except, your competitor. Your competitors will buy you. They'll give you your cash on your balance sheet. You'll get an earnout. You'll all have to change hats. You'll all work for you'll take your hat off and you'll put the other hat on. And it's like, is that what we want? I don't think so. So I'm into the housing czar. I'm into anything that takes confusion out of originating a loan.
This is The Big Picture. I'm Rich Swerbinsky with Onward and Upward Consulting, joined as always by my co-host, Rob Chrisman. This week, lucky to be joined by Bill Dallas. Some questions streaming into the chat. We've got about 15 minutes left. So anybody that has any questions, go ahead and put those in there and we will.
Good comments in there. Thank you.
Before we get to those, I did want to hit on just the NAR settlement really quickly. The winds of change. I mean, I think it's still an unknown how things play out. I've been on record saying I think you're going to see a lot of dual licensing at both real estate brokerages and mortgage lenders. Bill, how do you see this madness playing out?
I do too. Rich, I started that way, right? So when I started my business, I did real estate and I did the loan, right? One license. I had a broker's license and I was going to law school. And the first thing I said in law school was, I don't understand this duty of care that everybody has in real estate to the seller. Well, who's representing the buyer? Well, the buyer gets represented, but the seller pays the commission. So all the duty, all responsibility goes to the seller because they're paying. I said, that's a conflict. I don't think the buyer understands it at all. And I think we're now beginning to see exactly that play out. Now, they had to have a class action lawsuit. You had to go through all of that. But this is the biggest opportunity for mortgage. They are our core referral partner. And our core referral partner just went into the shitter. Right? So what is the biggest opportunity? I think it is dual licensing. I do think, and maybe not just the license, but you license your referral partner in a better way. And I have 2 or 3 companies that I've taught to do that already. And instead of hiring LOs, hire the realtor. I call it the newest thing in mortgage, D2R, direct realtor. And you just have to do it compliantly, right? You got RESPA, you got a whole bunch of rules. Just follow them. It's not that hard, right? But it's a great referral partner. And I think if I were doing it, if we've got to finance this, Rob, who's going to finance this? The mortgage guy, the mortgage company, the agencies. There's no way Rich is going to walk in. I want to buy a house. I got $5,000. Could you represent me? And the other thing that's just comical in mortgage is we're the only industry that I know that calls ourselves professionals and have no signed agreements with clients. 0, none. So all I've been saying from the very beginning is if you want to build a valuable franchise, sign your customer up when you take the app. You are their home equity advisor. They sign in. You don't have to charge them anything. You can put a time frame on it. But wouldn't it be cool for you to sit there and you own a company instead of saying, I've got 500 branches and 2,000 loan officers, which just sounds like a daycare. I have 150,000 customers under contract since my inception, right? That is how there isn't an industry that doesn't sign up their client, right? That has any reputation. I guess car industry. You want to be a car salesman next? CarMax, compete online, TrueCar? No. So we talk relationship, we act transactionally, and we are a broker without signing up the client. So my recommendation is sign them up, do exactly what you tell them what you're going to do, and help them manage their equity, help them get a home loan, help them get out of their home loan, help them forbear their home loan, be involved. We do a great job of doing this. We just don't contractually do a thing properly.
Rob,
and we never have.
Our friend Tracy King from Partners Credit in the chat, triumphing Chopra's comments, said not a lot of detail there. But I mean, the way I understand his czar-like powers, he can pretty much do whatever the hell he wants, right? He can just say, hey, listen, your fees are not this. I mean, is it that simple that if Rohit Chopra tomorrow wanted to just cap what the CRAs could charge?
Look what they do with late charges and other fees. They just come in and say, yeah, sorry, 7.5% is too much, $10. I mean, they can do it. I think credit companies are telling you the cost of credit is gone way up over the years. But Rob, what do you think?
It has gone up, but there's, I don't think credit was this sleepy kind of backwater thing that people barely thought of. Then all of a sudden the cost started going up, and you see, I have a flashlight shined on that industry, and people quickly find out, the ones who care find out that it's not all, the credit reporting agency's fault. You've got FICO in there, you've got the bureaus, you've got the CRAs, you've got companies adding profit margins possibly on the credit charges. And so there's a lot of blame to go around. Just like if you go back to 2008, 2010, there was a lot of blame to go around, whether it was the rating agencies or the brokers or the borrowers or whatever, a lot of finger pointing. So it's not all, oh, let's just blame the credit reporting agencies, or let's all blame FICO. Let's take a look at the process of mortgage bankers. And I mentioned this right from the get-go, the early part of the show, is when you ask companies about, gee, do you charge borrowers up front for running their credit, whether it's hard pull or soft pull? They all say, well, we talk about it, and then we ask our LOs, and our LOs say, oh, well, you're going to do that, then I'm out of here. Really?
But we used to, right?
Yeah, exactly.
At
exactly.
application, I'd get $500. I knew I had a deal. If I got enough money to pull the credit, then it was like, and ordered an appraisal at some point, right? But it was funny because we'd send it away, we'd order our credit, and then it would come in the mail about a month later, and you'd look at it and open up about 27 pages and go, holy crappy. I mean, look at what this guy is. He told me this, and it's this. Well, look, it doesn't cost them as much as they're trying to charge us for credit. Now, all the things that you said, scores have changed. You've got so many versions of FICO, but at the end of the day, it shouldn't be a 5 times upsell suddenly to the market when we're all in the crapper, right? And I think the housing czar, what would the housing czar do then? He would say,
well, you have a situation where the CFPB, I know one of the issues that came up was homeowners insurance that we were talking about earlier this week in Manhattan. And, the CFPB is quick to point out that they don't regulate insurance costs. You want to deal with homeowners insurance, that's a huge increase, thousands of dollars a year, but it's not our issue. Talk to somebody else. So there's plenty of, going back to the czar, the czar coming in and waving his or her magic
and you
wand.
look at, so what do we know? We know climate change is here, probably. We see fires. We see this increase in catastrophes. We haven't had an earthquake. I'm going to slap myself in California for a long time. It's about ready to happen, right? You have, just when you think it can't get any worse, it could. You already have insurers leaving. I sold my house in California, and my insurance was $25,000 a year. The insurance on my new buyer, the first quote and the only quote, was $150,000 for insurance in California. So it was like
6x versus what you were paying.
Yes. So
and that's for that 3-bedroom, 2-bath house in Barstow. Can you imagine?
Is that an AD?
Yeah.
Is that an ADU?
Yeah. Can you imagine if we?
That was an ADU.
Water. So you got a water shortage. you've got all these things that are when I started, like many of you, we used PITI plus MIU, right? We had generally maintenance, some estimate for other insurance costs and other utility costs, right? So, and I have a feeling that if we were correctly underwriting people today, there are homes that have severe risk of insurance, right? And I think that's going to begin, you're beginning to see the convergence. Then government will get involved in California and say, hey, you guys got to all come back. You can't all leave and just do one type of insurance and leave single families. And you can't just fly by in a drone, take a view of the roof, and cancel the insurance policy to a normal person who's paying. Come on. So all
Right.
of that just calls for a little bit different view of how you underwrite, review, and help a consumer to make a great decision about the home that they want for their life, their retirement, and for everything else. And we are valuable. You have that trusted advisor who provides good experience and access to capital markets and all those things is probably the most valuable thing for most Americans. No contract. We're sort of left out in the middle of nowhere. So I don't know, the companies I serve and I work with, I'm working my butt off to try to figure out how we figure out the referral partner issue, and then how we offer products that do help them take out equity. We fix our bloated costs, and we got to retain the asset. There are ways I could get you to retain servicing, right? You don't have to retain it all, but you have to retain a part of it. And now you've got retention. Now you can own the customer for life, but we've got to figure out what that means, because the other thing is what we're also suffering from is there's not enough at bats for an LO between 2% and 7%. They just, obviously volume's gone away. So I think it's time to pull out the 5-card stud and put the ace in the hole and do something different. And those strategic things will serve you well if you survive and get out of this.
If this bear market was to continue on for another 12 to 18 months, 7-8% rates and inventory challenges, who stands to benefit the most, do you guys think? Is it the single owner, more money than God IMBs, the cross country, the guaranteed rate group? Is it brokers? Is it curious both your guys' thoughts on if this market were to continue like this for an extended period?
You go first, Rob.
Who's going to benefit?
What, generally speaking, what tranches of the industry would pick up market share in your opinion?
I'm trying to put myself in the mindset of a first-time home buyer, and who do I go to? As much as people despise brokers, brokers have some competitive advantage, but if I'm a first-time home buyer, especially if I'm looking at builder product, I'm probably going to go to the builder mortgage company, especially if they're offering, some kind of juicy buy down, or, some kind of program that fits. When you talk to and I've done this, Bill, Bill, you've probably done it too, but when you, like in a restaurant or something, or you're just talking to somebody who's doing whatever, and you say, hey, I'm in the mortgage business. If you were going to go buy a house now, where would you get a loan? And a lot of them say, oh, I'd ask my parents, or I would ask my friends. And I think, Rich, to your question is, any of those business channels that we have now can do okay. It's a matter of trying to cultivate that referral base and find out where people get their loans and who they ask. And, you know, doing business the old fashioned way, you know, saying please and thank you and sending a thank you note, showing up at the closing. I think that goes a long way, regardless of the channel that you're in.
I think, Rob and Rich, I'm going to go down two paths, right? Already we see, so since I've been doing it, the banks have owned 70% market share. The SNLs have owned 70% market share. The brokers have had a 70% market share. The mortgage bankers have had 70% market share. And then these guys then the banks show back up again, and then the credit union. So my rule is, if you have a 70% market share, you're about to orphan the whole thing.
It's so true. It's like when the home ownership rate in America gets to like 70%, all hell breaks loose every time.
So we now have thrown the banks, and we're all now mortgage bankers, and we're winning. I think we're about to lose, right, if we don't change. So the winners are going to be the people that can create an asset out of all the stuff they do to create a loan. Because if you don't, there's no value in your franchise. Zero. Now, who survives? What I love about mortgage is and you mentioned a few of them, but these gritty little suckers who own their own businesses, who run them pretty well, they survive. And they've proven they can survive. Now, what's happening is they're all old. And they're getting older. So they all want out. And so how do they monetize that business? Right? If they can, you either transition it to your family, which there's a couple that are doing that. You bring in private equity to have some capital, right? You go public, or you do an ESOP, right? You see that in all these companies, right? All with a little different strategy. So my view is that the ones that actually prosper in the future are the ones that actually have figured out like Rob said, the point of sale. They have a low cost to produce, which would speak to the broker, not the mortgage company, because the brokers have a low cost to produce. Mortgage companies suck right now, especially retail. This other model of net branching and having all these net branches, I never thought it was compliant anyway, is killed them. Just killed people. Because you don't know what team they're playing for. I mean, Rich, you and I are Buckeyes, right? We don't like any other colors, right? Especially certain colors, right? And we don't even talk about the team up north, right? So when you think about the way the missionaries have come into mortgage, or we've created them, what I don't want the missionaries to do is look like the Wagner Group that eventually turns on Russia, right? Which is what happens. You have to build franchises where the people that work for you, work with you, actually believe in the color, believe in what you're doing, and are card-carrying people to create value for your firm. And the other piece is every time you create a posse, which a posse to me, I just love that term, right? My dad watched Westerns, and, we're going to send the posse after him, right? What's that mean? That means Rich, Rob, Bill, we get on our horse, grab our guns, and go grab something, shoot them. And so, but here in branches, what you suddenly see are in regions, you see LOAs, processors, you see underwriters, branch managers, you see a lease, you see all this overhead to do 4 loans a month. And in a big month, you're going to do 12, 20. Okay, stop it. The 2 companies that are printing money almost all the time, Rocket and UW, are centralized, right? And they figured out how to keep the customer for their broker or for themselves. Now they hate each other because they're the team up north to you and I. They're in the wrong state. But at the end of the day, I think they figured out how to do this. And we have to see these things that are working, retain the MSR asset at all costs, fix our bloated structure, you could do this today. Offer retained and released to your LO and kill your overhead all in, and fix the comp plan so there's no posses. Just pay the loan officer more. If a loan does come in, it's a variable cost, right? Just figure it out. Have him get rid of everybody because your price is going to improve. And all of that stuff you have to do if you're going to win, right? You got to be gritty, Rich, first, probably, because you've got to be a survivor, which a lot of the guys that you mentioned are just awesome at getting in the foxhole, fighting tooth and nail. And then you're like, we know there are just some other big things, technology, AI, right? Non-QM, other products, HEI, all these things that sort of sit around the rim that will eat at the core business. And how do you want to approach that? Right.
Good stuff and an enlightening conversation. So much going on right now in the industry, so much change, so much that could be different 6-9 months from now. And yeah, really enjoyed the conversation. The time flew by, as always, with some stuff in the chat. We didn't get to a lot of funny jokes in both the chat and the private Q&A about the housing czar, like careful what you wish for. What if it's Rich Cordray or Liz Warren?
No, it could be Wokey.
Right.
Or it could be Trump.
Yeah.
It could go, you can go to either side of that one.
Yeah. And yeah, we're definitely going to go down one of two dramatically different paths this November, depending on who wins the election. And we'll be talking about it all here on The Big Picture. And I want to thank you, Bill, for joining us. This was great. Really
guys.
Appreciate you coming on.
Yeah. Thank you, Bill.
Yeah, it was great.
Great catching up with you two, and appreciate what you do.
Yeah, likewise. And Rob, thanks for taking a little break from your adorable little granddaughter.
Do you guys compete against one another, by the way, in your consulting practices?
No. We love each other. Consultants love each other.
Yeah, I don't compete against anybody anymore. I love it. I could say whatever I want, and I don't compete against anybody. It's very liberating. So
there you go. Sounds like sending out a free commentary.
He forces me to stay out of Cincinnati or
exactly.
some markets that he wants to own.
Mm-hmm. Well, good stuff. I want to thank all of you for joining us, or if you're listening on podcast or on YouTube, and this will be delivered to those channels in the next few hours, as it always is, where we get a lot of after the fact viewing and listening. So next week we're fired up to have Sue Woodard on. Really excited to catch up with Sue, to get in the middle of that, and more good stuff coming as we get into the summer with The Big Picture. So until next Thursday, have a great rest of your week and weekend, everyone. Check you.
Thanks, everybody. Happy Memorial Day.
Happy Memorial Day, guys. Enjoy the weekend and take care, everyone. Bye-bye now. Bye.